If you're an agent in Florida, you know the CMA is everything. But listen, there's a new variable in the mix that can absolutely wreck your deals. Today, we're talking about insurance and how you can master it. And this isn't some made-up story. This is real life, happening right now all over the state. A perfect deal, everything lined up, and then it gets torpedoed at the 11th hour by a single number that was never on the CMA. So what is going on here? Well, the root of the problem is this. Florida's crazy insurance market has basically slapped an invisible second price tag on every single home. It's this shadow variable that can totally change whether a buyer can even afford a property. It's time we dragged it into the daylight. Think about it. Your standard CMA, it's all about looking backward, right? It's comparing old sale prices. But your buyer, they're looking forward. They only care about their total monthly cost. And when your CMA completely ignores a giant chunk of that cost, well, that deal is pretty much built to fail from the start. Just to give you an idea of how big a deal this is, the average home insurance premium in Florida is now $4,200 a year. That is 3 times the national average. It's a massive, massive line item that buyers just can't pretend isn't there. And here's the thing, buyers are getting smart about this. A whopping 87% are now asking for insurance estimates before they even think about writing an offer. This isn't a surprise variable for them anymore, it's just part of their basic homework. So the real question is it part of yours? Okay, so if you want to get ahead of your buyers and actually serve your sellers, you need to master the 3 key things driving these insane costs. Let's break them down quick and easy. First up, the big one. You probably guessed it, roof age. It sounds so simple, but the financial hit can be absolutely staggering. Let's circle back to that deal in Fort Myers. So the comp down the street had a new roof and its premium was about $2,800 a year. The house they were trying to buy? Yeah, its 19-year-old roof got a quote for over $11,000. That one difference added $640 to the buyer's monthly payment. It totally blew up their debt-to-income ratio. The lender couldn't approve the loan. And just like that, the deal was dead. All right, variable number 2 is a really sneaky one that can catch everyone off guard. Has the flood zone changed? You know, FEMA is remapping millions of properties, and a lot of sellers don't even have a clue their home has been reclassified. For instance, check out this neighborhood in Jacksonville. It used to be in Zone X, minimal risk, no big deal, but it got remapped to Zone AE, which means flood insurance is now mandatory. And just like that, you've added over $3,000 a year to the cost of ownership for every single home there. And what's the result of that? Well, any CMA using comps from before that change is basically pricing for a market that literally no longer exists at that address. The entire buyer pool just fundamentally shifted. And that brings us to our third and final variable, one that's often hiding in plain sight. Who is the current insurer? You need to ask, is the seller on one of those subsidized citizens policies? So let's say a seller in Coral Springs is paying a pretty reasonable $4,100 a year on an old citizens policy. Great for them. But a new buyer? No way. They can't inherit that policy. Their quote is going to be at the current market rate, which could easily be double or even triple that amount. So what happens? An offer comes in 20 grand below asking and the seller gets offended. But here's the crucial part. The buyer isn't trying to lowball them. They're just doing the math. They are pricing in the real cost of ownership that they are actually going to have to pay. So that's the minefield you're navigating. It's complex, for sure. But the solution starts with a pretty simple change. Having a new, way more informed pricing conversation with your sellers from the very first day. It's really just a simple 4-step framework. 1, you've got to research these insurance variables before you even think about pricing the home. 2, you calculate the real affordability impact for a typical buyer. 3, you contextualize your comps, explain why that house sold for more. Maybe it had a brand new roof. And 4, you use all this data to set realistic expectations for your seller from the get-go. Look, this is not about being pessimistic or killing the mood. It's about being prepared. It's about seeing that roadblock long before your client ever hits it. It's about being the most professional, most knowledgeable agent in that room. Your CMA has to tell the whole story. It needs to reflect the full cost of ownership. The question is no longer just, what's this house worth, but who can actually afford to own it? CMAflow's framework actually helps you answer that question right in your report. You can check it out at the link below. It's time to start the right conversation today.